video number 2 of the order flow module. And in video number 2, we are going to be covering what does it look like. We're also going to go over some data and eventually work towards what are good order flow lags and what are bad order flow lags. Now, what does it look like? Of course, it refers to what does an order flow lag look like, or what does order flow look like in general. Perfect. Now, in this video, we're going to cover number 1, basic order flow information. Then number 2, order flow transitions. Number 3, order flow sequence. Number 4, hedging perspective. Okay, basic order flow information. Now, some of the basic order flow information is things we have already gone over as well in previous enrollments, previous modules as well. But I want to repeat it because it's, of course, an order flow module, so we need to cover everything. So right here, order flow lags, that's what we're focusing on. Order flow lags are essentially those lags with fair value gaps in them, like we discussed in the previous video. What we expect from those order flow lags is that we expect them to hold. The word hold right there means that an order flow lag they get traded back into, we expect a new order flow lag from that. Meaning, from a bearish order flow lag, we expect a new bearish order flow lag to be created. That means the previous bearish order flow lag is holding. The same way, a bearish fair value gap, we expect a new bearish fair value gap from it. That means the bearish fair value gap is holding. And same for a bullish order flow lag, etc. So an example of this is right here. We have this bearish order flow lag initially, we trace back into that, and it holds and creates a new bearish order flow lag right there. Then from this new bearish order flow lag, we expect it to retrace back into it. And even if it doesn't, we expect this high right there to not be traded back into and to hold and create a new bearish order flow lag. That's important to understand. Now, right here, let's dive a little bit more deeper into that. So a little bit more advanced. We have the same order flow lags, but instead of looking at it from a candlestick perspective, I want to look at it from a PD ray perspective. Then we also have those swing points. What do we actually expect from those swing points? Then we have the time frames. So understanding how those time frames, of course, affect certain order flow lags as well. Okay, right here, we have a line at the bottom right there. And in red, we have the 3 different PD rays that we have. That line, imagine that price is there at this moment in time. Then these red PD rays, they are essentially resembling a bearish order flow lag. So in a high probability bearish order flow lag, we will first encounter a fair value gap when we create a retracement up right there. Now, if we do not encounter a bearish fair value gap, and we encounter first a fair value area, so the fair value area is below the fair value gap, that's not good. That's not a high probability order flow lag. But in a high probability scenario, we first have fair value gap, and then the more we retrace, we will now encounter a fair value area. And if we retrace even higher, we will now encounter a swing high right there. These 3 PD rays create an order flow lag at all times. When there's an order flow lag, you have all 3 PD rays right there. Very important. Now, for a bullish order flow lag, again, that line in the middle right there, let's assume market price is right there at that moment in time. When we create a retracement, so we continue lower back into a bullish order flow lag, we will first encounter a fair value gap, then a fair value area. And if we continue even lower, we will then encounter a swing low sitting right there. Now, right here, we have this line in between the swing high and the fair value area for the bearish order flow lag. And the same right here for a bullish order flow lag. Why is this? Because now I want to understand how we actually use those swing points right there. The further we retrace into an order flow lag, it does not mean that when we trade back into that swing point, we expect it to be swept to then still continue in the same direction. So what do I mean by that? If we create a deep retracement back into a bearish order flow lag, we retrace above the fair value gap, above the fair value area, and eventually we reach the swing high right there. That swing high becomes the target. It is not something that we want to trade from to continue lower. So even though it is named the last line of defense, it does not mean that we want to trade from it and we actually want to use it as a PD ray to look for a trade ID. That's very important to understand. We'll go over some different data points as well supporting that ID. But when we do not expect the order flow lag to hold, then the swing low or the swing high becomes the target. And it's not something we want to trade from. Very important. There's one nuance to this. There's one variable to this where we can potentially trade from the swing high or the swing low. And that leads us to time frames. Because let's say these order flow legs right here are on the 4-hour time frame. And on the 4-hour time frame, right here, we have those bearish order flow legs and those bullish order flow legs. But above the bearish order flow leg, we have a daily bearish order flow leg right there. And below the bullish 4-hour order flow leg, we have a daily bullish order flow leg sitting right there. Now, we have already gone over this as well. This just means right here that the 4-hour order flow legs are not in context right here. And that means that that order flow leg is essentially ignored. So we want to look at the daily order flow legs right there. And in this case, we can use the swing high of those 4-hour order flow legs and the swing low of those 4-hour order flow legs right there to then potentially use as a sweep to then continue higher, continue lower. But it doesn't have to be that crazy, because if you just zoom out, you go into the daily time frame, you'll find those daily order flow legs. This is things I assume you already understand as well from different enrollments and different modules, that those order flow legs need to be in context of higher time frame order flow legs as well. Very important to understand. I'll give one example. So right here, we are on the 4-hour time frame on crude oil, and we have this bearish order flow leg sitting right there. Now this bearish order flow leg right here, there is actually, if we zoom out a little bit and we go into the weekly time frame, there is a bearish weekly order flow leg sitting right there. Essentially saying there is a bearish fair value gap right here above the 4-hour fair value gap that we had right there. So in this case, the 4-hour swing high that we have can potentially be traded from, because it's a sting into the weekly fair value gap right there, to then potentially continue lower. In this case, we do not continue lower right here, and we actually continue higher overall. But that means that those order flow legs, they again need to be in context of the time frames above as well. Now, this is information that I believe most of us already understand. And this next one, I believe most of us already understand as well. But I do want to emphasize on it because I see it too often for my liking, that people do not trade off the most recent order flow legs. Always, and I mean always, when we are looking for a trade ID and we are looking for our entry, we are always trading from the most recent order flow leg. At any given moment in time, we are always trading from the most recent order flow leg. Let me state it this way. Order flow is always the recent legs. If you're not trading from the recent legs, you're not trading order flow in the first place. So that's very important to understand, because sometimes I mention, and in older enrollments or older modules as well, I mention you're not trading within current order flow. And that is what I mean with this. So let's take an example right here. We have this scenario right here, where we have this bearish order flow leg right there, and we expect a retracement back into it to then continue lower. So we want to trade a short idea essentially to continue lower. So we're trading from this bearish order flow leg. That's trading from the most recent order flow leg. That's good. This is perfect. Now, let's take an opposite example. At first right here, it starts off nice. So this is still good. We have the same example, that bearish order flow leg. We could expect lower prices from that to then continue lower. And we would be trading from the most recent order flow leg. Now, what if this happens right here? Because now we have disrespected this bearish order flow leg right here, and we have actually created a bullish order flow leg. So the most recent order flow leg is now a bullish order flow leg right there. This is important to understand, and it took out the previous bearish order flow leg high right there. This is important to understand, because now this is not something we want to look for shorts, at least. For longs, could be the case. For shorts, no. So this fair value gap right here that we had in a previous order flow leg to continue lower, which we already traded back into to then create a new bearish order flow leg, to then create a bullish order flow leg, this fair value gap is resistance, as we like to call it. So unmitigated opposing PD raise, but it's not order flow. So it's not a fair value gap that we can actually look for a trade ID, where we can go into the lower time frame right there to then look for an entry to continue lower. Now, unless of course it's the same example that we had with those time frames, where this bearish order flow leg The first one was on the 4 hour, and that time fair value gap above it is on the weekly. Of course, it's a little bit different. But if this is on the same time frame right here, and all the time frames are in context, etc., then this fair value gap is nothing more than resistance to potentially provide with a rejection. So can we continue all the way lower? No, we can potentially see a rejection right there to then continue higher instead. So something like this right there. This is important to understand, because when you are trading scenarios like this, you are trading against order flow, which means you are trading against a higher time frame trend, and you're essentially trying to call a top or a bottom in the market, which will not work out very well. So always look to trade from the most recent order flow legs. Again, is this doable? Is this doable? Trading that rejection right there to potentially continue lower. Is that doable? Yes, it's doable. But it's extremely low probability. It's very low probability because you're trading against the overall momentum of the market, the overall pressure of the market right there. The momentum at that moment in time is bullish. So the rejection is not even guaranteed in the first place. We might just want to continue higher all the way. So at the time you get the entry right there from that rejection, we might just shoot higher immediately because you're trading against the overall higher time frame momentum. And that's very important because then you're trading against the whole logic, the whole theory that we use. And that is, again, very important. So always trading from the most recent order flow legs. Very important to understand. Those fair value gaps that are not in the most recent order flow leg, they can provide a rejection. They can be used as a target, not something to trade from. Okay, now I want to go over, and to end the basic order flow information, I want to go over some data as well. Now, this is some data that I gathered for this video. And this data was gathered on the daily time frame on Euro US dollar for order flow lags between the 9th of October 2023 and at this moment in time when I'm recording this, the 7th of October 2024. So I determined the type of lag, first of all, an order flow lag right there, and then also a lag, and when I refer to just a lag, that is a lag without a fair value gap in it, meaning it's not an order flow lag, essentially. I gathered the lag data only from the 9th of October 2023 to the 13th of February 2023, because I already got to quite some, well, not necessarily decisive conclusions, but enough to show you the data as well. Okay, I want you to understand, first of all, before I dive into this, is this significant data? No, this is not thousands and thousands of order flow lags. But I need you to understand as well that the data right here, the percentages overall won't change a lot when you look at all different order flow lags as well. Now, it might be a little bit different, of course, and you'll likely not get to the exact same result. The more data you gather, the more accurate it will become as well. But the percentages won't change a lot overall. So it will stay within the same borders, essentially. So right here, for the order flow lags, I had looked at 32 order flow lags in total. Of those 32 order flow lags, there were 15 that followed through. So we're holding, essentially. And what I mean with that again is that the order flow lag was retraced back into, and we create a new order flow lag from that as well in the same direction. So it followed through. That was 15 times of the 32. So 46% right there. Then could you make the argument that wouldn't it be a higher probability to just simply buy or sell at any given moment in time? Because that would be 50%, right? Trading is not that simple. And trading is a little bit more nuanced than that. Because trading is not just simply buying or selling at any given moment in time. Because then you're forgetting one part of it, and that's risk management. What is your win rate? What is your RR overall? And do you have a stop loss and a take profit? And because we need a stop loss and take profit for our risk management as well, which will allow us to be traders, it's a little bit more nuanced than just buying or selling. So it's not 50% actually the market at any given moment in time. We need a lot more accuracy. Those order flow lags, they allow us to have a lot more accuracy as well, because those order flow lags allow you to also have a stop loss, also a take profit. So 46% is actually quite good. Now, context reached right there. So those order flow lags, they of course create a context area as we know it. And because they create a context area, then I counted the amount of times where it reached the context, but then swept the context to then continue in the opposite direction, essentially. So it did not follow through, but it did reach the context target. That was 8 times of the 32 times right there we had an order flow lag, so 25%. So you could make the argument right here that when you are looking, for example, in the Delirium trading plan, and we have those higher time frame PD rates, you have that higher time frame context for the order flow lags on those daily time frames, and you only need a rejection on the lower time frame, that when it reaches context right there, that's more than 70% of the time, essentially. That is extremely high probability already. And keep in mind, these order flow lags, I didn't look at if it was high probability or low probability, or if there was something else on the time frame above it or below it. No, I just looked at it at the order flow lag objectively. So 70% for the context reached, that's a high percentage, because again, if you add follow through and context reached up to each other, it's above 70%, and both of course reach context. Now rejection right here was 4 times out of 32. So where we did get a rejection from the order flow lag, but we did not reach context, and eventually the order flow lag failed, essentially. Now, when we talk about, again, the swept right here, we swept an order flow lag 3 times to then still continue in the same direction. So meaning what we talked about, those last line of defenses, those swing high in a bearish order flow lag, we are not likely to sweep that swing high to then still continue lower. Then we're more likely to continue higher in general. That happened 3 times out of the 32 order flow lags right there. So below 10%, 9% of the time right there in this example. Then 2 times of the 32, an order flow lag just simply did not hold. So it didn't get respected. We didn't even have a rejection. It didn't get swept. It just completely disregarded the order flow lag in general. That was 6% of the time right there. So we have a 70%. Well, you could argue the rejection is also somewhat in our favor, but we have a 70% chance that we at least reach the context low or the context high, which means we have a 70% chance of essentially our trade on the lower time frame already playing out right there. That's very important. Just purely based on, of course, the daily order flow lags right there. Now, in the same areas, essentially, I also looked at the lags. So just the normal lags without any order flow lags, without any fair value gaps in them. There were 15 of those that I actually looked at. There were more as well, of course, but I just gathered that data and I thought, well, this is already quite deciding as well. It proves the point that I'm trying to make. Then right here, we had 0 of them following through. So 0 of them actually holding, creating new fair value gaps when we trace back into those lags. Then 2 of those 15 lags right there actually reached context. So it's very similar. We have a bearish lag without a fair value gap in it. We did not reach the swing high just yet, but we did have a rejection where we reached the context low, essentially the context target low. That happened 2 times. Then we had a rejection right there from those lags if we didn't reach context or anything like that, 0 times. Then swept right there. So the thing I always mention, and I mention quite often, if we don't have a fair value gap in a lag, it's very likely that we can sweep it to then still continue in a direction. So a bullish lag that doesn't have a fair value gap in it, we can sweep the swing low to then continue higher, because that swing low is the last line of defense. It's also the first line of defense. It's essentially everything what we can trade off. So here, that happened 8 times, more than 50% of the time right there. Then it didn't hold those lags 5 times right there, 33% of the time, where it just completely disrespected it and nothing happened. We also didn't sweep it right there. So this data adds up to the overall theory that we have as well. Now, believe me, I was not very selective with this data. I was not specifically targeting euro US dollar. I was just using euro US dollar for the sake of it being euro US dollar. I was not being selective with this at all. Now I want to go over some more data right here in a Notion. What we're looking at right here is a Notion that I created for a YouTube video. The YouTube video from the top of my head is called something like creating a data-based fair value gap trading plan, something like that. And for that video, I also, very similar to what I did for this order flow video, I gathered data. Now, In this video, I also slightly refer to order flow lags, but I don't name it order flow lags essentially. So for example, for the data, I was only looking at fair value gaps in the most recent lag. So understanding when those fair value gaps hold and when they don't hold right there. Those recent lags with fair value gaps in them, they are, as we know it, of course, order flow lags, but I don't name it like order flow lags on YouTube. So holding means a fair value gap was traded back into and create a new fair value gap before taking out the lag the fair value gap is in. Very similar to what we mentioned, or the exact same, what we mentioned in the order flow video. But this is referring to a fair value gap, which is essentially also referring to an order flow lag. So this is all based on order flow lags as well. Now, the data was collected from 1 hour fair value gaps. This was on GBP US dollar, if I'm not mistaken, from this data window right here, from that time window. Now, in total, there were 39 fair value gaps in that time window right there. 13 fair value gaps were not in the most recent lag. Only one of those fair value gaps actually held. So the reason why we use fair value gaps in the most recent lag is because they already hold a lot better. Because fair value gaps that are not in the most recent lag, they have a 7% holding rate right there based on this data, of course. Again, is it significant data? Is it the most amount of data in the world? No, but it will tell us enough and it will tell us already what we need to know. And that's important. So here, there is 26 usable fair value gaps. So 26 fair value gaps that are in the most recent lag. So essentially 26 order flow lags. Okay. 14 of those usable fair value gaps do not hold. 12 of them do hold. Holding rate, that's funny. It's very similar to the Euro US dollar data. 46% as well of the order flow lags following through. So holding. Very interesting. Now, this is our baseline essentially. If we want to improve, how can we now improve? So if we only look at entering from all the usable fair value gaps right here, targeting a 2RR overall, we would get to a win rate of 42%, profit 7% right there. Now, is this something we can do and we want to do in the first place? You would be taking a crazy amount of trades in a very short time window. Your psychology is not going to take this. You are going to take trades that you shouldn't be taking. This is not something you want to do. Very simply said, this is not good. This is not going to end up with profit 7% right there and a win rate 42%. Because this, of course, is almost 100% mechanical at that specific moment in time. This is not something we want to do. So let's say we want to decrease our amount of trades as well. And we want to increase the overall win rate and the profit percentage. Now, if we only enter on the fair value gaps that held, so we enter on order flow lags that previously came from an order flow lag as well. Then right here, we have a win rate of 50%, profit of 6% right there. Now, okay, it's all right, but this is where it gets interesting. If we enter within daily context right there and in alignment with daily context, then we'll increase the win rate in comparison to the first thing that we looked at by almost 30%. The profit goes up by 10% right there, even though you take half of the trades that you took if you enter on all the usable fair value gaps right there. This is the focus right here. And what I just showed you is essentially how I got to one of my first trading plans, where I reverse engineered my own trading plan. So I started on the lower time frame, day in, day out, looked at fair value gaps that were holding and fair value gaps that were not holding. And I was trying to figure out what makes those order flow lags high probability. So what makes those order flow lags and those fair value gaps actually hold? And that is eventually what we're going to talk about right here as well. So the data is currently supporting the ID that we have, but we want to, of course, increase that a little bit, and we want to make sure we always trade from the best order flow. So we have to, well, before we get into that, we also have to go over order flow transition right here. Now, when we talk about order flow transition, we talk about a sharp turn, and we also talk about sharp turns that are not necessarily great sharp turns, but where there is a visual order flow transition as well. Now let's go over both of them. So right here, we are on Canadian dollar JPY, and we are on the 4-hour time frame. Now, if we take a look at order flow right here, we see that we have a few order flow lags. I'm going to mark out the fair value gaps just because I find that a little bit easier. These fair value gaps, those order flow lags right there, they hold and they continue higher right there. Now, eventually, we will come to a certain point where we create a bullish fair value gap right there, so a bullish order flow lag right there, and that will be followed by a very aggressive bearish order flow lag, bearish fair value gap right there as well. This is what is known as a sharp turn. So a sharp turn is essentially the following. We continue higher, continue higher, continue higher, and all of a sudden we have an aggressive move higher, aggressive move lower right there. That leaves behind a sharp turn, which oftentimes is also noted by fair value gap going higher and then followed by a fair value gap going lower right there. So bullish order flow lag, all of a sudden a bearish order flow lag right there. Now, this is what causes a reversal, especially a long term. The higher the time frame it happens, the more reliable the top essentially is in the market. This is what happens when we create a real top or a real bottom in the market. It creates a sharp turn. How did I get to that conclusion? Very simple. I studied with the understanding of those fair value gaps, etc. I then studied, well, what are real tops and real bottoms in the market? Then you very fast get to the conclusion they happen extremely fast. So call it a sharp turn. Now right here, we see a similar thing happen. We have that fair value gap right there going higher, and we also have this fair value gap going lower right there. That again creates a sharp turn. Most of us understand, I believe, what a sharp turn is. But something truly, what I love even more than this sharp turn is to visually see this order flow transition. Because when we have this fair value gap right here, we retrace back into this order flow lag essentially. We try to push higher right here with a few candles to push higher, and we fail to do so. Now that failure eventually leads to the creation of a bearish order flow lag right here, where we create this bearish fair value gap. That's the beauty of it, because now we visually see order flow not strong enough to push higher anymore, so it continues lower instead. When we create something like that in a sharp turn, in my opinion, it's even more beautiful. So if we take a look at some more examples, right here we see something similar. Fair value gap going higher, we retrace back into it, we fail to continue higher right there, and eventually we get that bearish order flow lag to continue lower. Beautiful, sharp turn. And similar right here happens because this fair value gap right here is still somewhat getting respected, but we're not strong enough to push lower, to push higher right there. So we push lower, create this bearish order flow lag right there. And that bearish order flow lag right there is then high probability, and it's very nice to actually trade from right there. That is what a transition looks like. Now, when is order flow confirmed? All things we've also, again, in different realms already gone over. But when we create the sharp turn, so this first fair value gap right there, what is the definition of order flow again? It's the first thing I would like to ask you even. The definition of order flow is PD rays holding towards one side, like we discussed at all the way at the beginning of the order flow module. This right here is one fair value gap. Well, is right now PD rays right now holding towards one side of the market? Well, previously the PD rays that we're holding were bullish discount rays right there. So bullish order flow lags we're holding. Then we have one bearish order flow lag, the bearish premium rays right there. So at that moment in time, are they holding? No. But when we then create a new order flow lag, a new fair value gap to continue lower right there, that means PD rays are now holding towards one side of the market. So we understand right there, order flow is confirmed to continue lower as well. Now, can we use this order flow confirmation at any given moment in time? So can we say, hey, let's go into the 15-minute time frame and I'm just going to look at order flow confirmations and I'm just going to trade whatever I want? You can, but is it the highest probability? Absolutely not. So we still need to understand, well, what then is, where does good order flow and where does bad order flow happen as well? And before we do that, let's also dive into the order flow sequence right here. Now, for the order flow sequence, we are going to be touching on the following. This is usually our expectation when most of us learn about order flow. Right here, we get those order flow lags right there. We perfectly respect everything. We have a perfect reversal right there. We get a beautiful sharp turn to then continue higher right there. Now, with order flow, it's usually not that simple because you also have to take into different time frames. You have to take into account a lot of different order flow lags as well on those different time frames. You have to understand those context areas, etc. So this is more so the reality that we're actually dealing with right here. where we get consolidation, 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 and we get a beautiful high probability condition cycle right there at the right side of our chart. So this right here is our goal, what we want to find. Now, does that happen all the time? No, it doesn't happen all the time. We don't have beautiful order flow all the time because a lot of times we're also consolidating. This is because institutions, they focus on higher time frame perspective. Their orders, like we mentioned, they are huge orders. So they are more so focused on the higher time frame because they simply cannot get involved. There's not enough liquidity on the lower time frame to easily click buy or sell like we can. So they are mainly focusing on the higher time frame. So they move from higher time frame level to higher time frame level. And in between moving from that higher time frame level to that higher time frame level, that's where on the lower time frame you will see beautiful order flow holding and where you can get involved as well. But in the meantime, if we don't move from higher time frame level to higher time frame level clearly, we will be consolidating. And that's not where you want to be involved. Very important to understand. So let's recap a little bit what we went over in the previous video before we go further into this advanced concept as well. Understanding the market is what we touched on in the previous video. We mentioned for every seller, there's a buyer. For every buyer, there's a seller. Institutions, the ones moving the market, they hedge positions. Institutions, they move the market based on the higher time frame. They do not move the market based on the lower time frame. It's all higher time frame, so 4 hour and above, because that's where there's essentially enough liquidity to get involved as well for them. So now we also talked about understanding those orders. So we have this buy position right there that we talked about and we understood, okay, if we want to buy on the other side of the market, there needs to be someone to sell as well. Now, it's very important to understand this again from an institution perspective. Because for us, of course, it's the same, yes, but the amount of quantity that's needed, the amount of orders that institutions place is, of course, a complete difference than what we use, essentially. So when they are looking to sell or they are looking to buy, they need a lot of orders as well. So let's take a look right here at a sell position. This sell position right here is, let's say we have that entry. The entry for us is a sell, but someone else on the other side needs to buy, essentially. So our stop loss is for us a buy order, and someone else needs to be willing to sell. Then our take profit is also a buy order, and on the other side, someone needs to be willing to sell. So needs to be willing to enter a sell position for us to be able to buy that position back, essentially that sell position, and to close our overall position. That's important to understand. Now, right here, now let's take that understanding and put it into the hedging perspective. Now, with this hedging perspective, I'm going to, again, build onto the idea that we had built in the previous video, but make it a little bit more advanced. So further, building it further. Now, right here, if we focus on this price action right here, we have this bearish order flow lag. We had price moving higher, creating that bullish retracement right there. Now, right here, institutions, they buy right there that retracement to even make the retracement happen in the first place. So they add some buying pressure to the market to retrace back into a previous buy level where they have a buy position still open. So they can close it and they can sell it. They can exit that buy position right there and mitigate it essentially. So don't lose any money from that buy position and also not necessarily make any profit because overall we are bearish right there. Okay, then right here, once we are below that low towards the left right there and the institutions leave behind that previous buy position right here, they buy again right there to bring it back towards that level right there to also close that position again. So they need to essentially sell to close that buy position. So there needs to be willing buyers on the other side as well. So they might trick some people in the market right there to then essentially sell, close that buy position, adding selling pressure to the overall market. So they remove that buy position. They are now essentially selling the market. So what happens? The pressure in the top right there, that scoreboard that we talked about, if we have a total of 100, there's now 20 buying pressure, but there's also 80 selling pressure. So that results in the market right here pushing lower and creating those bearish fair value gaps. But now it gets interesting because now we have reached a low right there. And what is that low? that low is where there are new willing sellers. So what is important to understand? Well, if they are in that sell position, those institutions right there, and they reach a low right there where there are even more new willing sellers, then let's say those institutions are not that interested anymore and they think the market has reached the bottom right there. They don't want to do anything anymore. So they don't want to be in a sell position anymore and they want to get rid of it. They will use this low where there are new willing sellers to offload that sell position. Because to offload that sell position, they need to buy, right? That take profit, that's a buy order. So there needs to be a willing seller on the other side. Willing sellers are below those lows right there because sell stops right there where people are, they see a bearish market overall. They think bearish strength right there. So it can continue lower right there as well. There's a lot of new willing sellers. So they can offload that sell position right there because they can buy that order back because there are new willing sellers on the other side of the market. So what happens at that moment in time when they get rid of that position right there, the pressure in the top right changes again. It changes right here from 20 and 80 to 80% buying pressure essentially and 20 selling pressure right there because they are now getting rid of that sell position by essentially buying back the market. So the buying pressure increases. So what happens when we reach a low like that? It continues higher and it sweeps the low to continue higher right there. Now, why is this relevant and why am I even telling you in the first place? And why did I even show you the data in the first place? What am I getting at? Arjo, can you just get to the conclusion of a story? Now, if we take a look at this scenario right here and we remove everything, then what are we essentially looking at? We're looking at a fair value gap, a fair value area right there that we can continue lower from. We are looking at a context area. And that context area holds and that context area reaches context boundary right there, context target low right there, because those institutions on the higher time frame are hedging. So where does order flow hold within a context area like that? If this was the yearly time frame, then on the monthly, on the daily, we could have beautiful order flow right there towards the context target. If this is the daily time frame, we might be looking at the 15 minute, at the 1 hour to reach that context low right there, the context target. And once that context target has been reached, we either sweep it or we run it. And that difference between that sweep versus that run, that will tell us right there if institutions are still overall bearish or are now getting rid and offloading those sell positions right there. This is important because this is what's going on when we are trading from a higher time frame level to a higher time frame level. We are trading a context area. So that is extremely important to understand. And this is why I oftentimes say as well that even though we might not follow through, if we can just reach the context right there, that's fine. And this is why I say so many times as well is that if we are going higher in a bearish scenario right here, then the context low is most likely still going to be reached. There's a high probability that we're still going to reach the context low because if we want to continue higher, the institutions need to reach that low in order to get rid of those sell positions to then sweep the low to actually continue higher. This is why those context lows and those context highs and the context areas are so important, because if you enter outside of context areas, you're not entering with the overall theory in mind. Very important to understand. So for homework, start finding good order flow conditions. And this is what we'll then work on throughout the order flow module. But based on all the information already given in this video as well, you can now start finding good order flow conditions and where you can potentially look for order flow, because you don't look at order flow at any random moment in time. This is what we build on in the next videos as well. All right, perfect. Thank you.